Stock market. Relevant waves versus irrelevant news. I'm Bob Stokes with Elliott Wave International. The stock market is a fractal. In other words, a self-repeating form at all degrees of trend, meaning without the time or price labels, you can't tell if you're looking at a 2-minute chart or at a monthly one. What's more, stock market trends unfold in repetitive and recognizable price patterns. What's more, these patterns, Elliott Wave patterns, emerge regardless of the news. Yes, there may be very brief reactions to news, but then the main trend continues. That's because the larger stock market trends aren't driven by the news. They are driven by market participants' bias, bullish or bearish, what we call market psychology. That's why you often see headlines with the word despite in them, like stocks rally despite U.S. unemployment at the highest level since the Great Depression, or stocks fall despite stronger than expected consumer confidence report. The word despite tells you everything you need to know. Review Part 1 and Figures 1 through 5 and Chapter 12 of Robert Prechter's 2017 book, The Socioeconomic Theory of Finance, and you'll see evidence that the market is not priced according to external conditions. And here's what the book says about those brief reactions. Evidence for even temporary emotional reactions in markets is surprisingly suspect. All market observers have seen futures prices gyrate more intensely for a few seconds or minutes before and or after an announcement perceived as major news. However, ensuing market movement may be totally opposite to the tenor of such news, even when it is a total surprise. This quote came to mind when on June 29th, this sobering news appeared on a major financial website. Nearly half the U.S. population is without a job, showing how far the labor recovery has to go. The employment population ratio, the number of employed people as a percentage of the U.S. adult population, plunged to 52.8% in May, meaning 47.2% of Americans are jobless. Interestingly, on that very day, the Dow closed up 580 points. Plus, as you know, the stock market has bounced back substantially since the March lows, despite a historic slew of negative news. Indeed, the June Elliott Wave theorists showed this chart and said, the first reports of economic contraction came out in March and continued through May. Stock prices not only rose for 7 weeks, but also jumped higher on nearly every report of a rise in unemployment claims. A particularly big up day occurred when statistics suggested an increase in employment, but analysts quickly recognized that the numbers were untrustworthy due to restrictions in data collection deriving from the pandemic. No matter, stocks went up the next day, too. In fact, you can also see that the stock market rose more than it fell when COVID-19 dominated the headlines. It also rose on the day of the first protests and continued to climb for 2 weeks, despite the vandalism, looting, and clashes between protesters and police not seen in decades. The real driver of the stock market's trend is investor psychology, which Elliott waves reflect. Learn what the Elliott Wave model is signaling about the stock market's next big move inside our investor-focused publications. You can do so without risking a penny. Follow the link below this video to learn about our zero-obligation 30-day instant access trial.